We start off with a big about face on Wall Street. Stocks are racing. Big losses to finish the day in the green. The move higher comes despite a host of developing threats out there. For one, no visibility. A quarter of companies that have reported so far in the S&P 500 have yanked guidance. China, threats of new tariffs and retaliation for its role in the pandemic. And the virus death toll, new reports that we could see 3,000 deaths a day in the United States. This as states begin to reopen. So is the action we saw today actually a sign that the market may be climbing a wall of worry? Guy.
Hi, Mel.
Hi, Guy.
It's clearly climbing something, and Tim's been on this theme, so kudos to him. And I got to tell you something. I was impressed today. The price action today was, very interesting. So kudos to the market and people that still believe in it. Out of the three things you mentioned, and loss of life obviously is the most concerning, but in terms of the market, this potential retaliation against the Chinese that Steve Mnuchin spoke about today and saying the Chinese were still going to honor their trade agreement. I personally don't think the market's paying enough attention to this. I happen to think this rhetoric is only going to get louder, and it in no way is market positive. So although today was very impressive, and energy really.
I think we're having some problems with Guy's shop. We'll go to Tim now in terms of your thoughts. I mean, the guy was saying that tariffs could be the biggest potential worry.
Energy.
We're still supposedly in the midst of a trade war. We only had phase one go into effect in February, and we've still got other phases to go. And yet we're talking about a ramp in tariffs at this point.
Right. And think about the jawboning that the market has gotten from the Fed. We've talked about it on the show recently, what the Fed has actually done versus what they said they could do. And so when you come out there and start talking about levying tariffs and going back to, trade war, even if it's just rhetoric, that's not what they want to do right now. They're trying to boost morale. They're trying to ultimately boost confidence in markets, but also in the global economy. So this is a little puzzling, whether you believe it has merit and base in purpose and efficacy. Guy was mentioning energy before we lost him. And I think that's something that at least is encouraging. So you're seeing some of the technical elements of the market. We obviously know that the supply demand fundamentals aren't great. We know what's going to happen to demand, but we've also had to get some sense of where credit issues for the energy space are systemic. And, we still don't know that. But oil's up 48% in 4 days. If you look at other constructive parts of where small caps and retail are trading, they actually were part of that resilient turnaround today. But yet, look, we had terrible data out of Asia, and those were PMIs from countries that actually gave us some sense of confidence the earlier month. Taiwan especially went from a 50.2 down to 41 and change on their PMI. So just because Asia's 2 or 3 months ahead of us doesn't mean that it gets better for them necessarily. And I think that's part of what we're starting to worry about.
Time and temperature of the markets for you, Dan.
Yeah, I think that, what Tim had to say about a lot of these different moving parts for just risk assets globally is really important. It's obviously been a very volatile period over the last 2.5 months or so. I'll just say about the U.S. stock market, pretty interestingly, towards the end of March, when it was down between 30 and 35% in a little more than a month, I think we all agreed that the selling became very indiscriminate, especially given what we didn't know about the health and the economic crisis. And just a week or so ago, prior to the bulk of S&P earnings here, I think a lot of us felt like things were getting a little too much overdone to the upside, up about 32, 33% from the lows. So here we are right now. We're struggling with this 2,800 level in the S&P 500, which is nearly the midpoint of that 2.5 month range, from 3,400 on the upside to 2,200 on the downside. And I think that makes sense. You used the term visibility or lack thereof, Mel, just before. That's where we are. We have to kind of digest what corporate earnings are going to look like. What are the next shoes to drop for the economy? And we just don't know right now. So the idea that the market takes a bit of a breather here and digests some of the commentary from the major companies, I think makes total sense. That being said, I think the market is totally pricing in a lot of really rosy scenarios with the S&P 500 only down 12% on the year, given what we know, despite all the stimulus. So to me, I still expect a retest at least somewhere, 10, 15% lower than current levels here.
Dan had mentioned the next shoe to drop. Karen, is there an assumption that there is a next shoe to drop?
I think there's a next shoe to drop in that I think that maybe the reopening doesn't happen as smoothly as we like, and that the rebound for so many companies isn't anywhere near what we hoped it would be. So I kind of agree with Dan. I think the market has really come way too far too fast. Looking through to the other side, we don't really know how far away the other side is. The one thing that is really important, though, is that the credit markets are wide open. So companies that 3 weeks ago or 4 weeks ago really were thinking very hard about their balance sheets, how are they going to survive, they're able to do deals now. I mean, this is some of the most active capital markets activity we've ever seen. So that's helpful. So, and the Fed has obviously said we will do whatever it takes. That's helpful, but I really don't. It feels like people think the Fed has given us an at-the-money put, and I really sort of don't believe that. I mean, I'm always looking for things to buy, and right now I find very little things to buy. It's amazing to me that 3-4 weeks ago there was plenty to buy. So I think this bounce back is really, really too far, and I think it's discounting a very good treatment, a vaccine next year, and a robust recovery in pretty short order.
The credit markets being open, though, Guy, I mean, that's really a lifeline for a lot of companies. That really extends the amount of pain companies can endure. We're talking about companies ranging from Ford to Avis, troubled company in a troubled sector, to Apple, which doesn't need the money but is going to raise the money anyway. I mean, we've got companies out there just raising money left and right with the Fed's implicit backstop to all of this.
Which is definitely market bullish, but it gets you down the rabbit hole of, should we be doing it in the first place, or should we be allowing the phrase I use, corporate Darwinism, to take over? And, I clearly favor that. It's not pleasant, but I think it's really vital and important and necessary. But to sort of echo the things Karen is saying, I find myself, I think Tim's on one end of the spectrum, and he's looking really smart about that now. I think Dan's on the other. I find myself closer to Dan at this point than Tim for a myriad of reasons. And I was mentioning this U.S.-China rhetoric that I think is going to continue to escalate. And I don't think in any way whatsoever that's bullish, or the market's giving it the consideration that it needs to. So, here we are at 2,800. I think it's a level where, you look at some of these stocks and you say maybe it's time to take some money off the table.